I'm Martin King, property analyst at Edison Investment Research, and I'm joined today by Stephen Ingles, who is Chief Executive of London and Scottish Property Investment Management, which is the property manager for Regional REIT. Stephen, welcome.
Good afternoon, Martin.
Stephen, you recently reported first half results for the 30th of June, but obviously your significant refinancing operation came after that. And I think that's probably what most people will want to hear about that and what your plans are going forward. But perhaps we could talk first about some of the operational trends that you saw in the first half, but also continuing since then.
Sure, no, happy to do so, Martin. Yes, as you rightly say, the refinancing is probably what most people are interested in. But nonetheless, we did have an active first 6 months. Most of the activity, of course, was reported in the prospectus, and therefore the vast majority of our investors and the investment world will be aware of that activity. But we continue to have an improving leasing market, and to that end, whilst slower than we would like, we did undertake 44 new lettings in the beginning of the year and the period of the first 6 months. And those new lettings were encouragingly at 8.6% ahead of existing ERVs. So that does encourage us that we are offering the right space to the market. Of course, we'd like to see that letting activity pick up. And I think we are, with the stability in interest rates, obviously we've seen one cut so far in the second half, but with stability in interest rates and inflation looking like it's under control, that confidence that comes from that will come through in the leasing market over the course of the next few months. And indeed, talking about now rather than the first 6 months, we are indeed seeing increasing levels of inquiries. So from a leasing occupational point of view, beginning to pick up, and we saw some evidence of that in the first 6 months.
And what have you most recently seen in terms of the back to work trend?
Yeah, I mean, we have been one of the sort of founders of this active tracking, if you like. We've undertaken a number of tenant surveys. We think we're a good bellwether of what's happening on the ground, given our 130 buildings and 850 odd tenants. So we have undertaken a couple of surveys. The last one was March of this year, so we published that in April. That was over 100 buildings, 26,000 staff members within those buildings, so a reasonable sample size. And what we've seen is an increasing trend and trending back to the office. It's been slow and steady, but as of March, 99% of our tenants were back in some form. And of course, the most important part for us is that's great, but how many people are back in and what trends can we analyse from that? And what we found was that we were now back to pre-pandemic occupancy, which is encouraging. Actually, we were slightly ahead as March. The new survey will be out in December of this year. It'll be interesting to see where that is. And most importantly, in the regional markets in which we have our assets, people were back just over, on average, 4 days a week. Obviously, that's an average. Some people back 5 days, some people back 3. But 4.1 was the actual number in terms of average days in the office. And that's very encouraging.
Thank you. If we move on to the refinancing, but before we go any further, could you just remind us how much you raised, what you're doing with the money, and perhaps also, for those who are less familiar with it, what the share consolidation means?
So we raised £110 million, and for three main purposes. One was to repay our resale bond, which required to be repaid in August, and that's now been undertaken. And the remainder split between reduction of our senior debt facilities and CapEx. But let me just elaborate on that very slightly. So as part of the devaluation in capital values caused by inflation and higher interest rates, our LTV had crept up to a level that we felt was not a sustainable level in the investment trust world. and therefore at 58%, which is where it was at the half year, that was high in our world. Not high in property leverage terms, but high nonetheless in the investment trust world. So we obviously were repaying the bond of 50 million, which increased our indebtedness, decreased our indebtedness. And indeed, we then looked at the senior debt facilities, which were ranging between 48 and 55% LTV against covenants of 60%. So, there was headroom there, but we thought that headroom could be improved upon, and therefore 26 million of the proceeds of the raise are being used to reduce the individual debt facilities to below 50%. And of course, what that does overall is improve the indebted position of the company as a whole, and that will be around 41% LTV post the exercise that we're doing just now. I'll come on to the capex in a second if I may, Martin, but let's just deal with what we're seeing in terms of the market and the banking sector as a whole, and we are obviously some way off refinancing of our debt facilities. The first is August 2026, but by reducing the individual bank facilities down to below 50% and further reducing them as we continue to sell non-core assets, we put ourselves in a much stronger position to refinance those debt facilities come August 26. And that's really the purpose for the repayment of debt at this time.
Stephen, you talk about increased capex. Obviously since listing, Regional REIT has always been focused on generating income and maximising dividends. Does this greater focus on investment in the portfolio, whether that be to enhance core assets or prepare them for sale, does that signal any change in strategy? Is it a bit of a shift towards more of a total return approach?
Yeah, it's a very good question, Martin. Yes, I think we indicated in the prospectus that what we would like to do is capture more of the enhanced value from some of the assets. So the company had been absolutely focused on income and holding void assets that may have an improved value for alternative use had a drag on that income. So we tended to sell those assets with some form of clawback in the event that there was enhanced value generated by the new owner. What I wanted to do was try and capture some of that enhanced value. And therefore, the capex monies that we've raised are twofold. One, to continue with our refurbishment program. And of course, REITs traditionally have to pay out the vast majority of all income. Therefore, as values begin to decline, capex it becomes more difficult. So we were capital constrained, and that to a degree held back our leasing program. So the majority of the capex raised will be to continue to upgrade and improve our existing portfolio. However, a portion of that will be utilised for fees. And those fees are planning fees and fees for architects, consultants, etc., in obtaining planning consents for alternative uses, where the alternative use is far and away ahead of the existing use value. And we've identified 20 initial assets where that is likely to be the case. And that will be staggered, obviously, as leases come to an end. But it will mean that we will retain some properties longer than we would normally have done, where we'd have sold earlier. We'll obtain planning consent and sell thereafter at a new enhanced value.
But with all that, Stephen, Regional REIT investors should still look towards the company being a good income stock.
Absolutely, we remain an income stock, and let's not go two ways about it. We remain an income stock, but now an income stock with capital value improvement through that planning gain that I was just discussing. So the total return might be made up slightly differently. It might be partially through income through the PID and the distribution of dividends, and maybe partly from capital gain. So the makeup of returns may be slightly different, but we absolutely remain an income stock.
Stephen, the fundraising went very well and you had a good take-up from existing shareholders. But of course, the underwriter has become your main shareholder, Bridgemere. What might they bring to strategy going forward?
Yes, we were very encouraged by the take-up from existing shareholders. It was very important to me and the board that we allowed shareholders to take up their entire allowance in the raise, and they were able to do that given the nature of the underwrite. But yes, Bridgemere are now our largest investor, shareholder. Bridgemere is the family office of Steve Morgan. Steve Morgan, best known as a philanthropist and having made his fortune through Red Row Homes, a national house builder. And I think the answer to the question of what they might bring is twofold. One, they're a very large family office and therefore are a very good stakeholder for us. Secondly, Steve Morgan was historically involved with the funds prior to listing back in 2015. So he was one of the larger investors in Fund 1 and Fund 2, which we combined to create the REIT. And therefore, there's a legacy knowledge there of some of the assets and indeed of the management team. So I think that, again, is a very positive aspect. And thirdly, he has deep knowledge of regional property markets, very much focused on residential historically, but he's done a little bit of commercial. But on that residential element, and I was talking earlier about alternative use, most of our assets are suitable for alternative use, and most of them are for beds or sheds. So, either industrial development or beds of some description, residential either to rent or to buy, student accommodation or hotels. And Steve Morgan has great knowledge in those markets, and we're hopeful and anticipate that he will be a positive influence and consultant in terms of obtaining maximum value from some of those alternative uses. So I'm really looking forward to having welcomed him as a shareholder, and I think we'll work very well together going forward.
Stephen, in terms of enhancing the portfolio and the core assets that will remain with you, you've made a huge amount of progress in improving EPC ratings across the portfolio. How does that position you in the marketplace, and how much more have you got to do?
Yeah, that is the crucial question. Very much focused on obtaining EPC A and B ratings across our portfolio. Already we're 60% plus there. Compared to the marketplace, which on average in the regional markets is 30% A and B. And that's vital because, as you know, we're required to reach EPC B by 2030 as a statutory requirement. But more importantly is what tenants are now demanding. Now, if you look at that from a purely logical point of view, if only 30% of the market provides the space that tenants require, and we're talking of occupancy of 75 to 80% across all major markets in the regions, then clearly that creates a position of undersupply of that quality of stock and over demand of tenants. And that positions us very well and is an absolute focus of the business. That's where the main rental growth will come from. And I think we've evidenced that in the last couple of years, last year achieving 13.5% of ERV, and this year already 8.5% ahead of ERV on those spaces that we have ready available to lease. So that's going to be a vital driver of the market over the course of the next couple of years.
So if I bring that all together, Stephen, you're doing a lot of work to enhance the portfolio and improve the income prospects for that, but also extract value in those properties which are perhaps non-core. It also looks that, as if the market itself, the occupier market, might be a little bit more friendly to you, and also the investment market. I'm conscious that around the sector, there's a huge amount of consolidation going on. Does all of this make you more or less vulnerable in that situation, and does it affect what you're doing?
Yeah, I think I agree wholeheartedly with your comments. I mean, in summary, yes, we think we've put ourselves in a good position for growth, both in terms of income and capital value going forward, assuming, of course, that we continue down the route of steady and improving interest rates. In terms of the M&A activity, yes, there's been a lot of it, as you've seen, Martin, over the course of the last few months. I think maybe the exceptional part of regional REIT is we are the standout office landlord in regional markets, and so there's no comparable to us. Yes, we could potentially combine with a much larger office provider in the southeast or London, but I think we are slightly unique in the offering that we have. We think there's lots of scope in our market to continue to grow and still be a relatively small proportion of the overall market. And therefore, I think the opportunity for regional REIT to go it alone continues and will continue in the short to medium term. But we have to grow. And we can grow, obviously, by capital values improving. That's a fair helping wind from the market. But we can also grow by adding value through, as you say, our change of use strategies and by improving income and therefore improving capital values that way. But I think, from a consolidation point of view, are we more or less attractive? I think we must look pretty attractive just now to some parties. There's no natural existing listed vehicle, though, for regional REIT. So therefore, I think we will continue to paddle our own canoe, so to speak.
Stephen, thank you very much.
Thank you, Martin. Take care.